Good morning, and thank you to EnerCom for making us a part of the conference again. It's great to be back in Denver. I used to work here. It was a wonderful city to live in. It's got a very collegial industry, and it's nice to see so many old friends again. So let me ask you to note the investment advisory we have at the beginning of the presentation, and then we've got a different one at the end. I'll start with an introduction to Tenaz. So we are a TSX E&P, symbol TNZ. The name Tenaz is a Spanish word. It means tenacity. Business model is to acquire and exploit producing and development assets primarily overseas. Why do we go overseas instead of North America? Given that we do have a long record of success on the management team in the US and Canada before, in addition to our international work. So why overseas? It's a great industry here, but it's just much more competitive than what we find in these overseas jurisdictions. With that less competition overseas, we get lower multiples in entry. In other words, a higher base rate of return on the transactions, and we find that there is more development opportunity, more opportunity to improve operations in these assets that we acquire outside of North America. Just less capitalized and really less emphasis on thorough development of the assets gives us a greater opportunity to do better once we have closed these transactions. Combination of that higher return at entry and better operating opportunities means that we get higher returns on capital to generate free cash and organic growth in our capital markets model. Current asset base, as mentioned in the intro, we're the second largest producer in the Dutch offshore, very high value gas market, something on the order of $15 per MMBTU. And we have a Canadian oil growth project that was a legacy from our recap that created the public company Tenaz. I'll touch on that later in the presentation as well. We have low leverage, about $100 million of debt, translates on a pro forma basis, including our most recent acquisition, of a debt ratio of about 0.7 times cash flow. We have demonstrated our access to both the equity and the debt markets in the 4-year history of the company, with equity with the original recap and a debt issue that we placed last fall, long-term notes in the Canadian market. So we do think that we have access to capital to continue to execute this acquisition model. I'll talk a little bit about the terms of our most recent acquisition, that of NAM Offshore. NAM is a Shell Exxon JV, and this is what created the large operating position we have in the Dutch North Sea. Statistics at the bottom of this slide, we're about a $600 million market cap. I'll point out that all the monetary values that we show in this presentation are in Canadian dollars unless we otherwise note. With that $100 million of debt, we have an EV of about $700 million. Pro forma production, counting a full year of production from the NAM Offshore acquisition, is about 13,000 BOED. We'll have about $100 million of CapEx this year, and as I'll detail later, there's pretty significant management and director ownership in the company, 11% on a basic share basis, 23% fully diluted. Every employee in the company is an owner, and we think that alignment is very important. The management team has worked together for up to the last 20 years at Baytex and Vermilion. We have 10 officers. 9 of the 10 worked at Vermilion together. The exception is Jen Russell Houston, who is our geoscience officer. She had the same position at OSIM. OSIM was a successful oil sands growth company that was bought by Strathcona, and she joined us at the time that we formed the public company Tenaz. 2 of these officers are with me in Denver today. John Balkwill, our business development officer, and David Burgart, our IR officer. We're very fortunate to have the board that we have. It's been really instrumental to the progress that the company has made over the past 4 years. All the key disciplines are represented: operations, audit, capital markets, legal. 2 of the 6 directors are from Europe, which is our main area of focus. We're really fortunate to have Marty Proctor as our chair. I worked with him when he was COO of Baytex. He subsequently became CEO of Seven Gens, very successful large gas growth company in Western Canada. Seven Gens was bought by ARC Resources, and he is now vice chair of ARC. Again, we're really lucky to have the board we have. They've been very important to us. This slide represents really the history of the company, the progress that we have made. I'll just rotate around the 4 panels here. On the upper left, we have our production pro forma for a full year of NOM offshore, the transaction that we closed in May. So it's been very substantial growth, 13x since the recap. As you'll see later, we've doubled the Canadian production, and we've added around 11,000 BOE in Netherlands offshore. On the lower left, we show cash flow or FFO, 40-fold improvement. Now, this is driven by the production growth, but also because we moved into the very high margin TTF market in Netherlands, and so we're having a lot higher netbacks on top of the production growth that we've experienced. On the upper right, we have our reserve value, which is up 24-fold. This is ATAX 10, independent evaluation by McDaniel. Again, like these other slides, these other panels on this slide, this is pro forma for the NOM acquisition, showing NOM present at year-end 24. Share price on the lower right, the recap was done at $1.80 about 4 years ago. Current share price around $21. That return probably places us at the top of the TSX E&P set. That's around 55 companies over this period. And I don't know the exact positioning, but I can imagine that we're very near the top of the TSX set of companies, around 1,800 of them in all sectors. The capital structure represented on this slide. On the upper left, we show the evolution to our net debt position of $100 million at year-end Q2. So in the dashed box, we have a cash position of about 230 million Canadian at Q2. Now, there are payables, other current liabilities. We include in that the first contingent earnout payment that we'll make for the NOM acquisition. I'll explain that in more detail later. Also, the long-term portion of the earnout on the NOM deal. We include the notes position that I'll cover in just a second. You cascade all that down, and you get to this 100 million Canadian net debt position at Q2. And again, that represents on a pro forma basis, including NOM for the whole year, around 0.7x debt to FFO. We have the notes issue shown on the lower left panel. Last November, we placed 140 million of 5-year notes to Canadian institutional investors on a private placement basis. That note has a 12% coupon, currently offered in the secondary market around 112, which will lead to about a 9% yield to maturity. Non-call at for 2.5 years after issuance, so we've probably got a little bit over a year and a half to call availability, and demonstrates, I think, our access to long-term debt. The equity or share position in the upper right, we have not made a secondary equity offering despite all that growth that you saw on the previous slide during the 4 years since the recap. We had retired about 8% of the shares through our NCIB. That's a program that is ongoing. And of that basic share position, the directors and officers have about an 11% stake, with that primarily coming in through the original recap investor that we made alongside the rest of the equity contributors to the recap. There are several dilutives, main one being the warrants that came with the original recap. Every employee in the company is incentivized with equity to provide that alignment. And if you just look at the D&O group, that's about 23% ownership on a fully diluted basis. On the lower right, we show, again, the evolution, but this time on a per-share basis of our reserve value, independent report by McDaniel. This is 2p10 on an ATAX basis, and that's a little bit over $40 per share reserve value, in what I think is a pretty conservative report. I'll cover that in just a second. From this, you would want to deduct the debt position somewhere in the range of about $3.50 per share to get a NAV for the company. Our reserve report has been done throughout our history by McDaniel. This isn't an audit of our internal numbers. This is an independent engineered report. It shows a 2P number of around 1.2 billion, combination of the Canadian, but primarily the Netherlands assets. I think it's a very high quality report. You can see the buildup by RCAT on the lower left. It conforms to National Instrument 51-101 in Canada and the COGI Handbook, which I think is a really effective reserve evaluation system. I think it's pretty conservative in terms of its booking. For example, in the NAM acquisition, we identified about 100 development drilling opportunities, and somewhere between 10 and 15% of those are reflected in this 2P report. So I think there's some opportunity for advancement of the 2P reserve position as we begin the development of those assets that we are just undertaking now that we're the operator. If you look at the right panel, this is McDaniel's independent assessment of the production trajectory, potentially, of the 2P reserves, and it shows about an 8% CAGR over the next 3-year period, primarily through workovers and this small amount of development drilling that is reflected in the report. As I'll talk about later, it's a pretty low decline asset, so we have a pretty good potential, I think, to generate organic growth, and then Canada also provides a small component of organic growth, continuing what we've done already. I want to shift just a minute to talk about the overall strategy or model of the company. The map that we show here shows two colors, light shading, light blue and dark blue. Both of those represent jurisdictions that the management team has worked in, either from an operating standpoint or a M&A standpoint in their career. So it's where we would consider ourselves to have experience. It's the dark blue jurisdictions that we would, at least at first screening, consider for investment. You can see that this is primarily in Europe. That is our top area of focus. A secondary area is Latin America, and we have some optionality to, I think, effect transactions in MENA, and we include Canada as another area of optionality. We did a small deal adding to the Altura asset set that we got in the recap. We're not really looking for a big expansion in Canada. We certainly have a great deal of experience in the U.S. It is, though, not an area that we're intending to compete in the future. It's a great industry here, very efficient, but there's many, many participants, and that really drives down a lot of capital as well, and that really drives down the rates of return that you can get on these base investments. Furthermore, the assets are typically pretty heavily capitalized, and kind of cuts that opportunity for improvement in production and unit costs as you after you make the transaction. So we are not really intending to compete in the U.S. Looking forward. What types of assets are we going for? Primarily conventional assets. These would be permeable reservoirs in primary or depletion or secondary recovery. Oftentimes, within the strat column overseas, we do see an opportunity for what we call semi-conventional development. This would be the use of horizontals, either with multi-stage fracs or unfracked multilaterals in some typically tighter clastic reservoirs. That type of development really has not been pursued much at all overseas. So typically we would identify some. It's certainly not included kind of in a bidding case. You don't typically have to pay for it because that type of activity really hasn't been pursued much, but it is an upside for us. So conventional and semi-conventional producing assets that have the opportunity for organic growth at the same time that they're throwing off free cash. It could be either gas or oil. The overseas markets that we're pursuing anyway are typically pretty high priced. Again, currently we have almost a 15 Canadian per MMBTU price in the European market. We're open to oil as well, although that hasn't been part of the international portfolio to date. Acquisitions we have made overseas are offshore. We operate in Canada onshore. We think we're capable of either. Pros and cons to both, really just depends on the value in the deal. Typically we prefer operated assets, but there are situations where there's a lot of value or growth or an operating or a future operating opportunity that might come with a non-op, and so sometimes we will make those deals as well. I already mentioned a couple of times the rationale for pursuing overseas assets as opposed to North American ones, and basically the combination of higher base rate of return and more opportunity for operating improvement leads to higher returns in the overseas market, feeding that organic growth and free cash flow model for us in the capital market. Let me touch pretty briefly, I would say, on the two sets of assets that we have. I'll start off with the Netherlands. This is 85% of our production now. The tracks that you see in the map are the entire maritime area for Netherlands. The three different shades of colors, operated production, non-operated production, exploration licenses, are where we have interests. This constitutes this roughly 11,000 BOED, almost 100% gas that we have offshore Netherlands, making us very solidly the number 2 operator at Netherlands offshore. And we do operate 80% of this production base. With this production base, there comes quite a lot of infrastructure control and ownership. There's 3 main pipeline systems, NGT, NOGAT, and WGT. We're involved in all 3 of them, and we operate the largest onshore plant at Den Helder that takes in all this production. So quite a strong position, long RLI, and again, I think that's with pretty conservative bookings, something around 14 years currently. Let me further touch a little more qualitatively on the asset quality, and then I'll talk a little bit about the development opportunities. So first of all, on the left, this is quite reliable production. Its vast majority of it is Rotliegend sandstone, Permian age. This has been the cornerstone of production in Northwest Europe throughout the industry's history. Very well understood, very predictable, generally pretty permeable production in line with the asset type that I talked about earlier, but some opportunities for tighter development even in the Rotliegend. The second point there about the operating base that we have, the quality of it. The assets at NAM were, again, owned by a 50-50 JV between Shell and Exxon. These are very high quality companies, and they have the highest asset integrity standards of any companies you would find in the world, and that's the asset base that we took over. The staff is equally good, very well selected originally, trained and mentored within really the Shell organization. There is a lot of infrastructure that goes with this, the 3 pipeline systems I mentioned earlier, serving almost the entire Dutch offshore. There hasn't been a lot of development, particularly on this asset base, for a long time, so the infrastructure used to handle a higher level of production. You can expand production without a great deal of CapEx going into the facility and pipeline system, so that's a big advantage for us. We operate the Den Helder gas plant with a nameplate of 3.4 BCFD. That's the highest nameplate of any gas plant in Europe. And the production has quite a low base decline. It's pretty permeable. There's been very little drilling, 1 net well over the last 5 years. So it is at about a 10% base decline. There's a lot of workover opportunity in itself, and we could probably replace that decline and grow some just as we get our workover program going in earnest now that we're the operator. We've got the development, exploration, drilling, and a variety of other types of projects on top of that. And it's that development opportunity that is really represented on this slide. It's the same map of the lands. I'll just briefly speak to what we list here. There is the entire range of development opportunities, starting with workovers of the base set of wells, which has been done to some degree, but actually in a pretty limited fashion over the past 10 or 15 years. There are a number of facility projects to put in additional compression, lower the back pressure, reduce the abandonment pressure for more reserves. There are gas discoveries that have been made but have not been tied into existing platforms. And then there's a whole set of development drilling opportunities. I listed that 100 or so locations that we have to choose from, and only a small subset is currently reflected in the reserve report. From a kind of a longer-term exploration standpoint, the entire asset base is covered by 3D. And in particular, within our biggest producing area called the JDA, Joint Development Area, kind of in the southern part of the land position, there is a brand new, high effort, high resolution ocean bed node 3D still being interpreted, and I think that'll yield a number of development, extension, and exploration opportunities as well. The activity really is going to ramp up in Q4. We're bringing in a barge to conduct workovers. We are contracting for a drilling rig, which should arrive in Q4 for a multi-year development drilling program. And in addition, we'll have a non-op well with a 21% interest going down in Q4 as well. So activity really later in this year, but a very extensive opportunity set on certainly a very undercapitalized asset. I'll speak briefly to the NAM offshore transaction that we made and just talk about the consideration because it affects some of the debt numbers that I mentioned going forward. So in the upper left, the base price for these assets was 165 million euros. That was based on a January 1, 24 effective date. It took about 16 months to negotiate everything and close the acquisition, closed on May 1. And with the interim cash flow during that period, after netting the deposit versus cash that we got back at close, we had to pay about 8 million cash to cover this 8 million euro cash to cover this 165 million euro purchase price at Jan 1, 24. Speaks to the cash generating capability of the assets. The key deferred compensation is called a contingent earnout in the lower left. And under this component, we will be returning 50% of the free cash in 25 and 26 and a quarter in 27 to NAM, to the sellers. It's free cash, so it's cash flow minus the CapEx that we elect to put in minus ABEX. There's no minimum payment. I mean, in theory, it could have been as low as zero. Maximum cumulative payment would be 120 million euros. It's paid 3 annual calculations for at 25, 26, 27. There will almost certainly be a payment under this, and we have estimated it, and it recorded this as part of our net debt at year-end Q2, including the current portion, which would reflect the 25 earnout payment, and the long-term portion for the last 2 years. That's 87 million Canadian out of the 100 million that we show as net debt in the company at year-end, at quarter-end Q2. There's 2 upside contingencies on the right side. Exploration contingency, where we would kick in with a royalty after a large amount of production on a new field discovery. We'd be very happy to pay that royalty because it would reflect a lot of value added out of exploration discovery. And on the lower right, a price contingency that covers 2028 to 31, where we would share in the incremental ATAX cash flows after hedging if the price exceeds certain thresholds, which start at $23 per MMBTU. So those would kick in at a very high price. Again, sharing at that point on an ATAX incremental basis, and another payment we would be happy to make because it would reflect a lot of cash flow coming in from these properties. Canadian assets that came in the Altura recap, I'll cover very briefly. We have a very good oil field that Altura found south of Edmonton, Leduc area, very large oil in place in the main zone, the Rex member of the Mannville. In this zone, we conduct horizontals with multi-stage fracs. We've added some new zones that we have identified within the Mannville that we'll develop with multilaterals with no fracs. That's our main drilling program now, actually. And we made a small asset acquisition that gave us more of this multilateral development. We have a 7/8 working interest and operating control, and there is infrastructure to increase production without a whole lot of CapEx going into pipelines and other facilities. As we see on this second slide about Canada, we've more than doubled production in the period since we did the recap, changed some of the fracs, we've brought in this multilateral drilling, and we think that we can continue to grow production here while throwing off free cash. So it's a valuable asset, not the main reason for the company, but certainly worthy of holding within the portfolio. Had a really successful Q1 drilling program, 3 multilateral wells making about 1,000 BOED, pretty cheap wells, about 2.5 to 3 million Canadian, DSET cost, 45 gross identified locations going forward, so we think we can continue this growth while throwing off free cash. I've got just a couple of slides to close with here, one reflecting our activity and official guidance. So we've done the Canadian drilling program already. We will have a non-op well, 21% interest, going down in Dutch North Sea in Q4. We'll begin our barge workover campaign. We'll start our multi-year drilling program as well, the operated program, typically around a 50% working interest. We have an 11% interest in a CCS project that is currently being evaluated, so there's a little bit of $2 million of CapEx that will go into that evaluation. And then, of course, we'll continue our efforts to identify and make additional acquisitions. When you talk about the guidance on the lower left, production for NOM offshore is only counted after May 1. So the guidance number is 9,000 to 9,500 BOED. It's not the pro forma numbers I talked about earlier. And CapEx, again, about 90 million development CapEx. The pie chart for this year shows 77% TTF. On a pro forma basis, if you had full year NOM, that's around 85% TTF, again, a very high value market. The majority of the remainder is Canadian oil. We do have a little bit of AECO gas, pretty low priced, in the mix, and I'll show how we try to protect that price on the next slide. So when we made the NOM offshore deal, we hedged about half for the first year and about a third for the second year. This does reflect our overall hedging position, including the previous non-ops that we had, Netherlands, a little bit over half hedged for this year, a little bit over 1/3 for 26. In the table at the bottom, in the middle, you look at swap price, you can see the prices that we have locked in over this 2-year period. The range is about $15 to $20 per MMBTU. We do attempt to hedge AECO as well. You can see the prices we have there in the kind of the $2 to $3.50 range, and we've got a collar on a portion of the oil, largely unhedged for that oil component that we have. This, though, a pretty effective program to control the cash flows and reduce the volatility of the cash available to execute the model. In summary, we think there's a big opportunity overseas, a higher return opportunity with our efforts primarily concentrated in Europe. The management team has worked together for a long time, very experienced with this model. We've done a number of transactions before in the overseas market, and we think that we can be successful in our go-forward efforts, adding to the assets in the company and adding value for the existing shareholders. And thirdly, the entire team, directors, officers, and all employees are incentivized to deliver for the shareholders, and that's what we think is almost the most important thing, that the entire group at Tenaz is aligned with the rest of our shareholder group. So I thank you for your attention to Tenaz, and invite anyone who's interested to go to our breakout session.